workshops at City Hall and to these webinars until further notice. I wanted to inform you that business licenses can be processed online, where applicable, by visiting www.chicagobusinessdirect.org. All BACP offices are open to limited members of the public. Please be advised that masks are required in all BACP facilities, and 6 feet of social distancing must be maintained at all times. While offices are open to the public, we continue to strongly discourage in-person visits. Please visit chicago.org/BACP for more information. If you are a part of BACP Entrepreneur Certificate Program, you can get credit for joining this webinar by sending the email to bacpoutreach@cityofchicago.org. If you wanted to learn about this program, please visit chicago.org/businesseducation. To help guide your business and employees during Chicago's reopening process, please visit www.chicago.gov/reopening. Also, BACP and the City of Chicago's Office of Emergency Management and Communications created Shy-Biz emergency alerts. You can opt in to receive targeted emergency alerts for the business community. If you are interested, please visit chicago.gov/Shy-Biz alerts. There are closed caption options available during this webinar. You can select to have this caption show up at the bottom half of the presentation by selecting the blue emoji, which is located at the bottom left-hand corner of your screen on the chat box. We encourage attendees to ask questions. Please use the chat box and send your questions to all panelists. There will be a Q&A session at the end of the presentation. Today's webinar is Finance Tools for Small Business Contracting, presented by Stephen Connolly, Small Business Administrator.
Stephen, you're on.
Very much. Everybody hear me okay? All right.
Yes, you're good.
Good. All right. Well, thank you very much to the City of Chicago for inviting me to make this presentation. I appreciate the opportunity to go forward and give information to the small business owners of the city. A little background first about myself. I've been with the Small Business Administration for over 25 years. Before that, I worked in the manufacturing sector of the economy in accounting and finance capacity. And I have a graduate and undergraduate degree in finance and accounting. And I work with the loan program the SBA has and the training program and various other programs that we do have with the SBA. So I'd like to get started. And again, thank you for showing your interest in this particular program. The Small Business Administration has the standard 7A loan program, which is a guarantee program that provides the guarantees to banks for loans that they are proposing to make. Most people, when they listen to the 7A program discussion, are thinking in terms of term loans. In other words, loans like to buy private real estate, buy fixtures and equipment, buy a business, start a new business, and all the rest of this, that these type of things require a term loan to finance. What they don't realize is there are two parts of the 7A program that are specifically allowed and organized so that they can be structured as a line of credit. And if you're going to be satisfying a contract, whether for the city of Chicago, the state of Illinois, the Cook County, the federal government, the federal agencies, the use of these particular programs would probably give you the financial strength necessary to finance the problem and to serve the customer, in this case, the unit of government. First, about the Express Loan Program. As the slide indicates, again, the SBA guarantees a bank loan. We don't make a direct loan to the business. In the maximum amount of the loan is $350,000. One of the qualifications is that any line that is guaranteed under this program must revolve, and it can only be renewable up to a maximum of 10 years. Now, SBA standard eligibility policies apply. That is to say that the business must be a small business. They must have good credit. They must provide financial information and projections that indicates that the contract is a contract that they have the capacity to fulfill, and all they need is the extra line of credit to cover the expenses of buying the inventory or paying the employees to perform the services. Also, the standard collateral policies that would apply in the event of a term loan also apply in the case of a line of credit. And the bank, again, will require a personal guarantee collateral, again, just as they would during any one of the standard 7(a) term loans. Again, the maximum amount of this loan can be $350,000. Another situation that happens with the express loan program is that you could possibly get two express loans, one structured as a term loan and the other one structured as a line of credit, if that's what you needed to satisfy the particular project or the particular service that you were rendering to whatever unit of government that you were dealing with. But again, this is for standard revolving type of credit loans or term loans involving equipment purchases or any type of thing where it's a short-term basis and you're covering a contract that has to be done and it run on a revolving basis. And this program is basically the most widely used SBA program in terms of the number of guarantees that we issue to banks. And we said there are several banks here in the Chicago area that use this program quite actively. So this is some information you may want to discuss with your banker if you get a contract or working with either the city or the state or whoever, and you're considering additional financing to support this contract. The next one of these programs we're going to talk about is also part of the 7(a) program, and this is known as the CAPlines program. This again is something that can be used to guarantee short-term expenses or create new assets. The maximum loan guarantee will go to $5 million. And again, this is not a direct loan by the SBA, but we're guaranteeing a loan made through a bank. Now, the advantage of the CAPline program is that you can either have a revolving feature or what is called a termination contract feature. And this is why there are 4 sub-programs: the working capital program, the contract program, the builders, and the seasonal. And these programs, again, will allow the business to either finance an individual contract job by job, or you could use the working capital much as you would use the express working capital loan as a revolver to support the purchase of inventory or the payment of salaries and creation of receivables. It is possible for a business to have 2 CAPlines, one structured as a contract CAPline to cover specific contracts that are being worked on, and another one that is covering a working capital to support sales that you're making to the particular unit of government that you're talking about. The key with the cap line is that the total amount of the guarantee, the two loans together, cannot exceed the $5 million figure. And as far as the express is concerned, again, as long as that loan, you could have two loans there as long as you didn't exceed the $350,000 figure. That would be possible to do two loans, again, depending on how you structure it. Now, the SBA will guarantee, when we guarantee the working capital loan, we follow the normal practices as far as the organization of the line of credit, the dispersion of the money, the repayment of the money, and all the rest of that type of thing. This also with the contract line of credit, you have to have information on the particular contract or contracts that are being financed under that particular program. The main thing that you have to worry about with the contract line of credit is that you must have evidence that you have been awarded the contract and that the contract is one that your company has the capacity to fulfill, and the only thing that you need is the money to pay the wages and buy the raw material to fill contract. So these are things that you have to consider. Now the cap line also, like the express program, is a program that involves meeting the SBA's size standards for the business. It involves good credit. It involves providing financial statements, copies of the contract, and also the history and background of the business to the bank so that they can decide whether they want to get the contract. The builders and the seasonal lines of credit are lines of credit that can be used by the business for particular seasonal obligations. Again, these would not be related to particular contracts, but certain seasonable. Now, one of the points I want to emphasize, when you make your proposal to the bank, the decision as to which of these programs would apply to your situation will rest with the bank. It does not rest with your business. You will go to the bank, make the proposal, show them your financial information. In the case of the contract, provide the contract information. Give all of that to the bank. The bank will review it and they will decide if they want to use the SBA guarantee. Then they will make the application and take it from there. So this is basically what happens with these two programs. We've seen examples of in the contract program of where companies that were subcontractors on various types of public works construction jobs, such as road paving and CTA rail jobs and things of that sort, have been able to use the contract line of credit and getting the program started. And again, for these programs, again, talk to your banker. There's more information about them, and they do offer you a potential opportunity to finance your contracts that you would be doing again with the city or the county or whomever you would be doing it with. So those are very very significant aspects of the process. But again, these are guarantees, and they can cover any type of contract, and they can help your business get or sustain work with the federal, state, or local units of government. So that pretty well summarizes the capital CAPlines guarantee section of the 7A program. So it's seasonal in nature. Next, we're going to talk about the surety bond guarantee. And this is the nice movement from the contract line into the surety bond guarantee. Some of the times, if a business is awarded a contract and they're going to perform the contract, depending on what the unit of government they're dealing with, depending on the nature of the job they're doing, depending on the history of the business and a number of factors, primarily and state and federal law in this area, the business may have to get a payment or performance bond, what's called a contract bond, as a condition of being awarded the contract. One of the requirements that SBA enforces is that if we're going to guarantee a loan under the contract or working capital program and a contract bond is required, one of the conditions is going to be that the borrower is going to have to provide evidence that they are properly bonded and they've gotten the bonds to cover the particular contract that they're being awarded and how they're going to perform on this contract. And so the program that the SBA has to cover that is the Surety Bond Guarantor Program. And as we talk about, this is a program where we guarantee the bonds to the bonding company. So we will get on to what the bonding situation. And what is it? What is contract bonding? Now, contract bonding is it's possible that you will not finance the contract through use of the SBA contract CAPline program, but still you may be required to get a bond. And contract bonding is basically different from standard surety bonding. Now, why would a small business need help? First of all, they've been relying on general contractors to do an assignment of liability, and they've now got to the point where they can't get that anymore, and they've got to go out and do the bonding on their own. Another possibility is that they have a bonding capacity, but their bonding capacity, let's say, is only $50,000, but they're doing a series of jobs where they'll need bonding capacity of $100,000. Also, another possibility is that the contractors using what is called funds control agreements, where the bonding company gets the payments of the invoices from the government agency, and then will forward the money on to the contracting company. So that's a situation. And also you've had using fund control in other ways to control there. And also that the cost of the bonding exceeds the 4% level. What is the necessary? The small businesses struggle with contract bonds. One of the things we want to make is that standard surety bonds are different than contract bonds in this regard. A standard surety bond, the beneficiary of the bond is determined by either statute or court ruling. The example I like to give of a standard surety bond, best example is a bail bond, because in that particular case, you're getting the bond because the state law requires that for the protection of the general public. So therefore, when you're putting up a bail bond, that's what you're doing. In the case of a contract bond, that is not what it is basis of it. In a contract bond, what has happened is that you, as the provider of a service or good, have entered into a contract with somebody who will become your customer, and the bond ensures that you will perform services for that customer under the terms of the contractual agreement. Many people, when they apply for a contract bond, react by saying the questions that are asked in the forms look like I'm filling out a bank loan. Well, in fact, you are a bank. It is a bank loan. And the problem with a bond is that it's a bank loan you hope you never have to use. Because the bond, if it ever has to be used, it's going to go to the customer. It's not going to go to you. It doesn't benefit you, it benefits your customer. So when surety, when bonding companies are underwriting a bond, they look for what are the 3 C's: capital, credit, and capacity. Now, capital refers to the overall financial condition of your business. In other words, what is your cash flow? What is your net worth? What are your financial parameters? How are these various parameters working? What are you doing? How are you going? All the rest of this sort of thing. Credit, of course, is your character. And this is whether you honor your contracts, whether you don't honor your contracts, how you work with the various vendors and customers that you deal with. Get what's your credit, and make sure do you have concern about things about you have a criminal record, what is your banking relationship, and all the rest of that. Capacity is the ability to do the job. Does your company actually have the operational ability? If you're let's say going into a bid on a contract to put new plumbing in a police precinct station for the city of Chicago Police Department, do you know enough about plumbing to actually install the equipment and fulfill the contract? One of the things where surety is different than the banking is that one of the elements that goes into approving a contractor for a contract bond is that they must provide evidence that they know how to do the job. So one of the things that every bonding underwriter looks at are testimonials from satisfied customers. If you're bidding on a job for the city of Chicago and you're telling them that you've done this same work, let's say for police precinct in the city of Milwaukee or the city of Detroit, you're going to want a letter from the Milwaukee or Detroit verifying that you did the work and that the city was happy with the work that you did. And that's going to be part of the application package that you're going to send into the city. And again, small businesses, because they don't have the overall capacity to work with the bonding companies alone, the bonding companies will come to the SBA for help if they see a worthwhile type of project. What is the situation where the surety bond would be required? Again, usually a bonding company will come to the SBA in one of the situations shown on this slide. In other words, if you're a new business and you're emerging, let's say, again, using my example, you were a plumbing company and all you've done is refit bathrooms in people's houses. and now you've got this job to do all of the plumbing facilities at a fire station for the city of Chicago. Uh, you you may need all the bonding support because the city may require the bonding, and they may require that you have the capacity to do the work and show the work. Another thing is that you have limited financial resources. In other words, your circumstances is you have a good banking relationship, and it doesn't really show a cash flow picture that you need to get more information in that. And again, the internal financial statements, um, and you need to provide internal financial statements because generally bonding companies like to look at financial statements that are prepared by independent accounting firms, not necessarily CPAs, but some sort of independent accounting firm. And subcontractor, in other words, you're a subcontractor that's grown to a position where you are the uh, prime contractors are not going to give you an assignment of liability anymore. You're on your own, and you've got to get your own bonding, or they won't hire you as a sub. So this again are the situations where the contractors would come to the SBA to get the help. Now, what is the advantage to the surety company of getting an SBA guarantee of the surety bond that they're doing? One of the things that the Small Business Administration does is that as far as what is called the bank line of credit, or BLOC, means that we'll look at the financial statements, and we will, under our formula, we will increase the bonding capacity. Again, in the available, if the available, let's say the available line of credit or support from the bank is, let's say, $10,000. When we determine the bonding capacity limit, we'll raise that to $20,000. And that will again help the bank. Again, bonding capacity will double. And again, it has to have internally prepared financial statements, letters from satisfied customers, and all of that type of thing has to be included in the process. Eligibility. What makes a business is eligible for the bonding agent to consider using the SBA program to support the contractor? First of all, like with the loan program, the bonding program, the business must qualify as a small business. It must meet the SBA's size standards. And also, the contract can be no more than $10 million. And the solicitation for the contract or the contracting must require that the contractor have bonding for the particular service contract. And then, of course, we'll have the evaluation by the insurance company and also by the SBA staff to determine that all of the standards I was referring to, financial consideration, satisfied customers, and all the rest of that is met prior to going forward with the contract situation. This is our major program right now within the surety bonding. It's called the CAP program. And this program is a streamlined type of program. It's similar to the Express program within the loan guarantee area in the sense that it is geared to help small businesses with small jobs. just like the express guarantee program will not go over $350,000. The quick cap program will not go over $400,000. Again, the SBA has a very the forms for doing this are very simple, and it's for any type of a contract or a subcontract that would be under $400,000. And again, this again has become the most popular program that we have within the surety bond guarantee area. What do you need to apply for a surety bond, regardless of whether they go through SBA or not? First of all, you need business financial statements, and you need the owner's personal financial statement, and you need a letter of recommendation from a bank and a letter of recommendation from customers. Now, if the surety company decides that they want to use the SBA guarantee program, what they will do is they will contact the SBA, and we will electronically send them a set of forms, and they will pass them on to the contractor. And then the contractor will fill them out. So if they use the program, again, the standard material that's required for a surety bond, plus the SBA guarantee application forms are required in the application package. Now, as far as the cost of this situation, there are costs involved. One of the things you should do is to know the total bond and cost rate. Now, SBA does charge a contractor fee, but that fee does not come into play unless the contract has been awarded. In the surety area, if anyone tells you that they charge fees for bid bonds, thank them for their time, either hang up the phone or end the conversation and go elsewhere, because standard practice within the surety industry is that the fees being charged do not start until such a point in time where the award has been made to the contractor, and that's when the fee. And the fee that the contractor will pay is 0.6%. So if you had let's say a contract of $100,000, that would mean that the SBA fee to that contractor would be $600. Yeah, no, a $100,000 contract. So it'd be a very 0.6%. Now, one of the big advantages is the question of the surety bond premium. Now, the surety bond premiums are regulated on a state-by-state basis. And the insurance commissioners, the individual states, will set the ceiling as to how much the bonding companies can charge as a bonding premium. Now, that figure, depending on what state you're talking about, runs between 1.5% and 3%. Now, what happens with a lot of bonding companies is that if they don't use if the bonding companies will tack on all kinds of extra fees, and in the case of the SBA guarantee program, the only additional fee that the contractor would pay would be the contractor fee and then the bonding premium. And again, the bonding premium will be lower. In the first slide, we talked about you wanted to have the bonding amount was below 4%. And the reason for that is that the SBA system allows the bonding company to charge market standard rates rather than penalize you with higher rates. What is the application process? The one thing you might remember is that the surety program works through insurance company, doesn't work through banks. And like the old line about life insurance, also true with regard to surety bonding. The time to work with the surety agent is before you need them, not when you need them. It's like you don't want to buy auto insurance when you just had an accident out on the expressway. You want to buy auto insurance when you get the car so you're prepared and ready to go, or you don't get life insurance when you're in the funeral parlor. You get it beforehand. And anytime that you're in business, and if you're going into a line of business where bonding is a possibility, the first rule of thumb is to deal with an insurance company or work with an insurance agent who has connections to bonding underwriters, and work with that insurance company because you're going to need the bonds, and the insurance companies are how you get them. So the first thing you do is you contact, once you've been bidding on the contract, and let's say you've been awarded the contract, and you go to your agent and you say, well, we were talking about the situation, and I finally got that contract for $1 million from the city of Chicago, and they're going to make me get a bond for the contract. And your agent would look at that, and then the agent could either go through the bonding process with the surety carrier, or they could go through the SBA. And let's say if they decide that they want to go through the SBA, well, they'll contact the bond underwriter, and the bond underwriter and the agent will review it together, decide that the SBA is the way to go, and they'll submit the application to the SBA, and we will review it. And if we issue the guarantee, we'll issue the guarantee. But again, that will be in the favor of the bonding company and the agent, and not the contractor. So if there's a default on the bond, the SBA will pay off the bonding agent and the contractor. I'm sorry, the bonding agent and the surety company, not the contractor. And then again, when we'll issue the bond, and the point to remember is that assuming that you have got a good relationship with an insurance company that you know, and you're working with somebody, the turnaround time on bond guarantee applications is less than 2 days. But that assumes that you're dealing with an agent and a company that you know and have worked with for a period of time. This is a list of all of the insurance companies that are qualified to use the SBA program. These are the all of it. You can see all of the major companies that use the program, and this is so we have a list of program carriers that could use it. This is all the insurance companies. So if your agent deals with any one of these companies, they are eligible to use the SBA Surety Guarantee Program. And again, you start the process by contacting an SBA authorized agent. I have a list of agents here in Illinois who are qualified to use the program here in Illinois. And also on the SBA website, there is a list of qualified agents. Now, the one thing to remember about qualified agent is that the in the insurance industry, agents are regulated by state government, not the federal government. So a lot of insurance agents that you're going to have, you're going to see these lists on the SBA list, and here in Illinois, of the 37 agencies that we have here that use the program here in Illinois, there are only 2 of them that are headquartered here in Illinois. The others are headquartered in other parts of the country, but licensed to do business in Illinois. So you could use any one of the 37 that you want to use. And they will deal with them, work with them, and they can help you. Even if they have a presence here in Illinois, fine. And they had to have some sort of a presence in the state to get licensed here. So that's we could provide you with information on where you a bonding agent. And if you have a bonding agent right now who's not familiar with or doesn't know that much about the SBA program, have them give us a call. We're more than happy to talk to them and go through the process to see if they qualify to become a vet. We'll go through the vetting process, and if they're qualified to get into the program, we'll take them in as a new agent. These are the guarantee offices. These are the folks that the agents deal with. The contractors do not deal with these particular offices. And you can see by the map, the state of Illinois, we deal through the Surety bond office in Denver, and they are the ones that work with the agents and the underwriters. Okay. So that pretty much fills up my area. Anybody have any questions about the express or the contract line of credit or the CAPlines or any of the bonding programs? I'll look forward to hearing from you. Any questions or comments? Thank you for your attention. Appreciate it.
If you have any questions, if you could please put it in the chat. Stephen, I'm looking to see no questions. So thank you for the great information. We really appreciate you coming out and presenting to us. This webinar has been recorded and it will be posted at www.youtube.com/ChicagoBACP. Everyone have a great weekend, and thank you again, Stephen.
Thank you.